Imagine waking up one morning and realizing that the house you worked your entire life to buy is no longer really yours. Not because you missed a payment yesterday, not because you made a reckless decision, but because the system itself quietly shifted underneath you. Across the world right now, forces are building that could push more than 40 million homeowners into financial ruin by 2026, and most people don't even see it coming. This isn't about fear or exaggeration. It's about numbers, trends, and historical patterns that repeat whenever debt, interest rates, and asset bubbles collide. If you own a home, plan to buy one, or believe real estate is the safest investment on earth, this is something you need to understand before it's too late. To see how this unfolds, we have to start with the uncomfortable truth that modern homeownership is built almost entirely on leverage. Very few people actually own their homes outright. Instead, they own a promise, a long-term agreement with a bank based on the assumption that income stays stable, interest rates remain manageable, and property values either rise or at least hold steady. For decades, this assumption worked because central banks kept rates falling, money cheap, and credit easy. Mortgages became larger, loan terms stretched longer, and home prices detached from wages. In many countries, the average home price doubled or even tripled while real household income barely moved. This gap was filled with debt, and debt feels invisible when rates are low. But when rates rise, debt suddenly becomes very visible. Over the last few years, interest rates have moved faster than at almost any time in modern financial history. Central banks, facing inflation they themselves helped create, pulled the emergency brake hard. Mortgage rates that sat near historic lows suddenly doubled or tripled. A payment that once felt comfortable became a monthly strain, especially for adjustable rate borrowers or those who bought at peak prices. In the United States alone, millions of homeowners locked in ultra-low rates during the pandemic housing surge, but tens of millions more bought just before or after rates began rising. For them, refinancing relief vanished overnight. The safety net people assumed would always be there simply disappeared. Now combine this with something even more dangerous: inflated home values. When prices rise too quickly, they don't just reflect demand, they reflect speculation. Investors, short-term flippers, and institutional buyers poured into housing, turning homes into financial products rather than places to live. This pushed prices far beyond what local incomes could support. History shows us that whenever housing prices decouple from earnings, the correction is not gentle. It doesn't arrive with a warning bell. It arrives through falling liquidity, tightening credit, and forced selling. And forced selling is what turns a slowdown into a crash. The next pressure point is employment. Housing markets don't collapse just because prices fall. They collapse when people can no longer service their debt. A slowing global economy, rising corporate bankruptcies, and shrinking profit margins all point toward labor market stress ahead. Layoffs don't need to be massive to cause damage. Even a modest rise in unemployment can trigger widespread mortgage distress because so many households live paycheck to paycheck. When income drops but mortgage payments stay fixed or rise, defaults become a math problem, not a personal failure. This is where many people misunderstand foreclosure risk. It's not only subprime borrowers or irresponsible buyers who lose homes during downturns. In 2008, millions of middle-class homeowners with decent credit were wiped out because their equity evaporated. When home values fall below loan balances, selling becomes impossible without bringing cash to the table. People become trapped, miss a few payments due to illness, job loss, or rising expenses, and suddenly the bank controls the timeline. 40 million homeowners sounds extreme until you realize how many are stretched thin, over-leveraged, and dependent on economic conditions remaining perfect. Another factor quietly increasing risk is property taxation and insurance costs. As home values surged, so did property taxes. Insurance premiums followed, especially in areas exposed to climate risk, natural disasters, or regulatory changes. These costs don't adjust downward easily. Even if home prices stagnate or fall, taxes and insurance often keep climbing. For many homeowners, these expenses now rival or exceed their principal payments. This creates a slow squeeze, one that doesn't make headlines but steadily erodes affordability year after year. We also need to talk about household debt beyond mortgages. Credit cards, auto loans, student loans, and buy now, pay later obligations are all at record or near record levels. Rising interest rates don't just affect mortgages, they affect everything. When minimum payments rise across the board, something has to give. Historically, housing is often the last bill people stop paying, but when the burden becomes unbearable, even that line gets crossed. The system doesn't care how hard you worked, it only cares whether the payment clears. What makes this cycle especially dangerous is how confidence masks risk. Most homeowners believe real estate always recovers. They point to past rebounds and long-term charts that only go up. But those charts ignore time, stress, and forced exits. A homeowner who loses a house in a downturn doesn't benefit from a recovery 5 or 10 years later. They're already out. The recovery belongs to whoever bought the asset at distressed prices. That's how wealth transfers happen quietly, legally, and repeatedly across generations. At the same time, large financial players are preparing, not panicking. Institutional investors are sitting on cash, watching for price dislocations. Banks are tightening lending standards, not loosening them. This is a signal. When credit becomes scarce, prices follow. Ordinary homeowners don't get early warnings or special access. They react after conditions change, while institutions position themselves beforehand. This imbalance is one reason downturns feel sudden to the public but predictable to those watching the plumbing of the financial system. So when we say 40 million homeowners could lose everything by 2026, we're not talking about a single event or a dramatic overnight collapse. We're talking about a convergence of rising rates, inflated prices, economic slowdown, tightening credit, and household overextension. Each factor alone is manageable. Together, they become systemic. History doesn't repeat perfectly, but it rhymes closely enough to ignore at your own risk, because the real danger isn't the headline crash everyone expects. It's the slow motion unraveling that happens while people are still telling themselves everything is fine. This is how housing crises actually destroy wealth. They don't begin with sirens and breaking news alerts. They begin with subtle changes that feel manageable at first. A missed refinance opportunity here, a higher renewal rate there, an insurance premium increase that eats into savings, a tax reassessment that adds a few $100s a month. None of these seem catastrophic alone, but together they push households closer to the edge without them realizing how little margin they have left. One of the most underestimated risks heading into 2026 is the wave of mortgage resets. During the ultra-low rate era, millions of homeowners chose adjustable rate mortgages, interest-only loans, or short-term fixed products to qualify for higher-priced homes. These loans were sold as smart financial moves because rates were expected to stay low forever. But history shows rates don't stay artificially suppressed without consequences. As these mortgages reset at higher rates, monthly payments can jump by hundreds or even thousands of dollars. For a household already stretched, this isn't an inconvenience, it's a breaking point. At the same time, home equity is not as solid as many believe. On paper, rising prices created trillions in housing wealth. But equity only matters if it's accessible. When prices stall or decline, lenders tighten home equity lines, reduce cash-out refinancing, and raise credit standards. The equity that homeowners assume they could tap into suddenly becomes locked. It's like having money frozen behind glass while bills pile up in front of you. In past downturns, this illusion of wealth disappearing has been one of the most psychologically devastating shocks for homeowners. Then there's the investor exit problem. In many markets, a significant percentage of homes are owned by investors, not families. These investors are far more sensitive to cash flow, interest rates, and price momentum. When rents stop rising or financing costs increase, investors don't hesitate to sell. When enough of them rush for the exit at the same time, prices drop quickly. That drop doesn't stay contained to investor-owned properties. It resets comparable values across entire neighborhoods, instantly reducing equity for owner-occupiers who had no intention of selling. This is where negative equity becomes a trap. When homeowners owe more than their property is worth, options disappear. Selling requires cash most people don't have. Refinancing becomes impossible. Relocating for a better job becomes harder. People become stuck, and stress compounds. In previous cycles, negative equity was one of the strongest predictors of default, not because people wanted to walk away, but because life eventually forced them to make impossible choices. Another layer of risk is regional concentration. Housing downturns don't hit everywhere equally. Some cities and regions are far more exposed due to rapid price growth, speculative demand, or reliance on volatile industries. Areas that saw the biggest booms often experience the sharpest busts. Homeowners in these regions may believe national averages don't apply to them until local job losses or falling prices prove otherwise. 40 million homeowners doesn't mean 40 million identical stories. It means millions of individual tipping points scattered across different markets, all triggered by similar pressures. We also have to consider demographics. A large portion of homeowners are nearing retirement age. Many plan to rely on home equity as part of their retirement strategy, either by downsizing, selling, or borrowing against their homes. A housing downturn at the wrong moment can permanently alter those plans. Unlike younger homeowners, they may not have time to wait for a recovery. Selling into a weak market locks in losses that can't be rebuilt with future income. This is why comparisons to 2008 only tell part of the story. Today's system is different, but not safer. Lending standards improved in some areas, but household leverage simply shifted forms. Instead of risky mortgage products alone, we now have layered risk across mortgages, consumer debt, and asset prices inflated by years of monetary intervention. Central banks have less room to cut rates aggressively without reigniting inflation, which limits their ability to rescue housing markets the way they did before. That safety net people assume exists may be thinner than they realize. As conditions tighten, banks don't act emotionally, they act mathematically. When risk rises, they protect their balance sheets. This means stricter lending, faster foreclosure processes, and less flexibility for struggling borrowers. Homeowners often assume banks will work with them indefinitely, but history shows patience declines when losses mount. Foreclosures don't spike all at once. They accumulate quietly, month after month, until the scale becomes impossible to ignore. Meanwhile, inflation continues to erode purchasing power. Even if wages rise nominally, they often lag behind the real cost of living. Groceries, energy, healthcare, and transportation all compete with mortgage payments for a share of income. Housing doesn't exist in isolation, it sits at the center of a household's financial ecosystem. When everything else gets more expensive, the pressure on housing becomes relentless. What makes this moment especially critical is timing. The next 2 years represent a convergence window. Debt levels are high, savings rates have fallen, and economic momentum is slowing. Homeowners who bought recently have the least equity buffer. Those who bought long ago but refinanced repeatedly may have extracted much of their original cushion. The system looks stable on the surface, but stability built on leverage is fragile. It only holds as long as conditions don't change too much, too fast. And while most people focus on housing itself, smart money watches something else closely: hard assets. Historically, periods of housing stress coincide with rising interest in assets that sit outside the credit system, assets that don't depend on someone else's promise to pay. This is where precious metals quietly re-enter the conversation, not as speculation, but as insurance. Gold and silver don't solve housing problems, but they reflect a loss of confidence in paper wealth. When homeowners feel trapped and liquidity dries up, capital looks for safety elsewhere. All of this leads to a question every homeowner should be asking right now, not whether prices will go up or down next month, but whether their financial position can withstand a prolonged period of strain. Can payments still be made if income drops? Is there real liquidity or just paper equity? Is debt manageable if rates stay higher for longer? These questions aren't pessimistic, they're practical, because the difference between surviving a downturn and losing everything often comes down to preparation rather than prediction. And that preparation becomes even more critical when we look at what could unfold next, as we move closer to 2026, and the final stage of this cycle begins with the stark reality that the next few years could reshape homeownership for an entire generation. By 2026, millions of households may find themselves staring at numbers on a statement that no longer makes sense, wondering how years of work and sacrifice evaporated seemingly overnight. The truth is, it won't be overnight for everyone. For some, the collapse will be slow, a creeping erosion of equity and stability that finally reaches a tipping point when job loss, illness, or rising interest rates push them beyond the threshold of affordability. Others will face a sudden shock triggered by local economic changes, mass investor sell-offs, or regional housing corrections that hit hard and fast, leaving no margin for recovery. What makes this crisis unique is how it intersects with multiple layers of modern finance. Home mortgage ages no longer exist in isolation. They are tied to complex financial instruments, mortgage-backed securities, and large-scale institutional portfolios. Banks, hedge funds, and investment firms are all interlinked, meaning localized housing stress can propagate quickly through global markets. While it might feel abstract to a single homeowner, the consequence is very real: tightening credit, frozen refinancing, and accelerated foreclosure timelines. What was once a personal debt problem now has systemic implications, echoing the 2008 crash, but in a different structural environment where rates, inflation, and leverage play different roles. In addition, household behavior has changed over time, and not always in ways that increase resilience. Many homeowners live paycheck to paycheck, with minimal savings for emergencies, relying on the assumption that asset prices will continue to rise. When prices stagnate or fall, that assumption fails. The psychological impact is severe. Stress, uncertainty, and forced financial decisions can lead to rapid exits from the housing market. People don't just lose homes, they lose confidence, security, and often the ability to rebuild until years later, if ever. 40 million homeowners is more than a statistic, it's a cascade of real human experiences, each influenced by timing, luck, and preparedness. Part of the challenge is that government and institutional responses often lag behind reality. Policy interventions are reactive rather than proactive. Relief programs take time to design, funding is limited, and bureaucratic hurdles slow distribution. In some cases, relief is targeted at the wrong population or doesn't scale with need, leaving large portions of homeowners unprotected. History shows that waiting for rescue often means waiting too long. The difference between those who survive a housing correction and those who lose everything often lies in foresight and proactive planning. Another key factor is regional disparity. Some markets are far more resilient due to strong employment, diverse economies, or slower price growth, while others are hyper-exposed because of speculative booms or concentrated industries. Homeowners in the most over-leveraged markets are particularly vulnerable. They may feel isolated, thinking this only happens elsewhere, until local conditions suddenly shift. When multiple factors converge, rising rates, falling home prices, stagnant wages, the resulting defaults ripple through communities, affecting banks, neighbors, and even schools that rely on property taxes, compounding the impact beyond individual homeowners. Precious metals and alternative assets also deserve attention in this context. When confidence in traditional wealth collapses, capital naturally seeks tangible stores of value. Gold and silver have historically served as hedges against systemic risk, not because they guarantee financial security, but because they remain independent of the banking system and market volatility. For homeowners watching debt obligations rise and asset prices waver, reallocating a portion of wealth into hard assets can offer a buffer, a way to preserve liquidity outside of potentially collapsing financial structures. It's not a cure-all, but a protective strategy in uncertain times. The final risk lies in timing and compounding pressure. Mortgages reset, equity evaporates, regional corrections hit, and job stress mounts, all while inflation continues to erode purchasing power. These pressures do not act linearly, they amplify one another. Rising costs in one area can trigger defaults in another, and localized stress can cascade nationally. The 40 million homeowners at risk are connected not just by financial products, but by the larger economic ecosystem in which they live. When the pressures synchronize, the outcome isn't a minor slowdown. It's a structural realignment of the housing market itself. What should homeowners do? Awareness is the first step. Understanding your debt exposure, interest rate risk, and liquidity options is critical. Prepare for higher monthly payments, even temporarily. Evaluate options like refinancing while rates are manageable, building emergency savings, or creating alternative income streams. Consider diversifying assets to include holdings less exposed to systemic financial risk. History teaches that those who take proactive steps survive disruptions, while those who assume it can't happen to me are often the hardest hit. Finally, it's about mindset. This looming crisis isn't designed to scare, it's designed to illuminate reality. By understanding the forces at play, analyzing your position honestly, and preparing for scenarios beyond the headlines, homeowners can navigate what may be the most challenging period in decades. The risk is real, the math is undeniable, and the window to act is now. Those who take proactive steps may emerge with their home, savings, and financial security intact, while those who ignore the warning signs could see everything unravel by 2026.